Silver just closed the week above $67 during the thinnest trading period of the entire year. But here's the part most people are missing. Based on simple gold, silver math, silver is still priced as if it's deeply undervalued. In fact, at today's gold price, a return to historical ratio levels implies silver well north of $200. That's not hype, it's math. And tonight I'm going to show you how that math works, why silver's market behavior changed this week, and what price levels actually matter next. Last week we said one thing mattered most, the US dollar index. We said that as long as the dollar stayed below 99, silver had room to extend higher, even into year-end. That is exactly what happened. Silver finished the week at $67.18. Gold closed at $4,338, and the dollar index ended at 98.69. Silver didn't drift higher, it accelerated. That matters. The dollar remains the primary driver. As long as the dollar stays below that 99 level, silver does not need permission to move. Every attempt by the dollar to recover has failed. That tells us pressure remains in the system. Gold led the initial breakout earlier this year. That role has now shifted. Silver is leading the expansion phase. This is not unusual. It's how precious metals bull markets behave. Gold signals the change. Silver expresses it. For the last 6 to 7 weeks, silver followed a fairly consistent weekly rhythm. Strength out of Asia early in the week, consolidation midweek, then selling pressure into Friday. We've talked about that pattern repeatedly, including earlier this week. But this week that rhythm broke. Asian buying still appeared. Midweek consolidation still held. But the expected end-of-week selling never showed up. Instead, silver expanded into the Friday close and finished near its highs. When a well-established rhythm fails like that, it tells you something important. The marginal seller is gone. That's not noise. That's a change in market behavior. After a move of this size, the market stops thinking in terms of indicators and starts thinking in terms of structure. On pullbacks, traders are watching Fibonacci retracements, not because they expect a collapse, but because they want to see whether demand absorbs selling. So far, retracements have been shallow. That's constructive. On the upside, Fibonacci extensions give us reference zones, measured from the 2024-2025 base near the low 20s to the recent breakout above 67. The first major extension projects into the mid to high 70s. The next projects into the upper 80s to low 90s. Further extension begin projecting into the low 100s. Those aren't targets. They're areas markets tend to react to when acceleration replaces consolidation. Now let's put the gold-silver ratio into proper context. At the beginning of 2025, that ratio was north of 100 to 1. It took more than 100 ounces of silver to equal the value of 1 ounce of gold. Historically, readings like that only appear near major silver undervaluation extremes. Today, that ratio has already compressed to roughly 65 to 1. That tells us a large part of the imbalance has started to unwind, but not all of it. Over long monetary history, the ratio has often gravitated toward 15 to 1. Even in modern markets, many analysts argue that 20 to 1 is a realistic compression level. Once silver begins to outperform, with gold trading near current levels, a 20 to 1 ratio implies silver around $215, without gold needing to move higher at all. That number isn't a forecast, it's arithmetic, and it shows how much imbalance still exists in this market. Silver didn't move higher because of a headline. It moved because multiple forces that have been building for years are now acting together. Monetary confidence is weakening. Physical supply remains tight. Industrial demand isn't optional anymore. Investor positioning was light, and gold already signaled the shift. This is what acceleration looks like when those forces align. Next week is different. It's Christmas week. Liquidity will be thin, participation will be light, and price moves can be exaggerated. In either direction, silver can overshoot levels or pull back sharply without changing the underlying trend. The zone between $65 and $66 is now critical support. As long as silver holds above that area, the trend remains intact. 68 is short-term resistance, and $70 remains the psychological magnet. Here is the clear forecast for next week. If the US dollar index stays below 99, silver has room to continue pressing higher through Christmas week. In that case, price is likely to work between $67 and $70, with volatility and brief pauses along the way. If the dollar recovers back above 99, the picture changes, but it does not break. In that scenario, silver would likely pause or retrace into the $65 to $66 range first. If dollar strength holds for several sessions, silver could work lower into the 62 to 64 zone. That would represent consolidation, not a failure of the larger structure. When markets move like this, developments don't always wait for the weekend. This is the kind of environment where breaking news and special reports matter. If conditions change, we'll cover it as it happens. If you're stacking physical silver, gold, or copper, Silver Forecast has partnered with APMEX, one of the most trusted bullion dealers in America. You'll find our affiliate link in the description below. Look for our Silver Forecast Christmas special, released Christmas Eve, and for what copper is doing alongside silver. That's Copper Forecast. Now let me ask you this. Do you think silver continues higher from here, or do we get a sharp holiday pullback first? Drop your thoughts in the comments. We'll see you in the next report from Silver Forecast. Have a Merry Christmas and Happy Holidays.